Hey, good morning. Hope everybody's doing well. This is another little coffee with Kirk. We're just gonna, again, it's just an opportunity to talk about different topics every week and then maybe offer the opportunity for you to ask some questions. So let me pull up my screen here, get the presentation going. So this week, I just wanted to take a little bit of time to talk about the Federal Reserve. I find it's something that a lot of people, they don't really understand how it works. They kind of understand that Fed is a pretty big player in the financial markets, but they're not really sure how it functions and what it does. And I just want to talk a little bit about what they're doing right now, that they're taking some unprecedented steps. And it seems like every crisis, it gets bigger and bigger and bigger. So what I'm going to do is just try to give you a really, really quick overview of what it does. And then again, open up the questions, anything that you're, thinking about, wondering about, throw it at me. So again, we'll talk about, it's called The Creature from Jekyll Island, because the Fed was conceived on Jekyll Island in Georgia. And then we'll do some questions. But I find it's a pretty good idea to always sort of understand how banking really works. And this is something that it's important just to understand it, but it's really important when you start to understand what the Fed's doing. So we have a system, it's called fractional reserve banking. So what that means is when you go in and you take $100 and you deposit that into the bank, well, the bank has to keep some reserves. So if you come back in to take money out, they have to have something back in the vault to give you. So that's the reserve amount. Now, it's not the full amount. Now, if you put $100 in, you could go back in and the next day take $100 out. That's not a big issue. But what it is they keep a certain amount. Right now, typically the reserves is like 10%. That stays at the bank. And the other 90% gets loaned out. So that other 90% leaves the bank, goes into home loans, it goes to business loans, all those kind of things. But that 90%, when somebody gets a home loan or they get a business loan or something along those lines, they then take it to their bank. So that they take the $90, put it in the bank. Now the bank's going to keep reserves for that $90, 10%. So they're going to keep $9, and then they're going to loan out the other 81. And again, this is going to happen again. So somebody's going to get that 81. They're going to take it to the bank. Bank's going to keep $8.10 in reserves and issue the rest. So as you flow through the entire process, your initial $100 deposit is going to create $1,000 in money in banking. So it's leveraged. It's leveraged basically 10 to 1 when the reserve ratio is 10%. So when you think about that, just really quick, it doesn't take a whole lot of defaults on loans to bankrupt a bank. If 10% of their loans go bad, they have wiped out their reserves. So you can kind of see why throughout history we've had bank panics and bank runs, because there's really not a whole lot in the bank for protection. That's one of the issues. That's why we have a Fed, because they were having runs and panics and all that kind of stuff. So a lot of people don't really understand how the banking system works. They think they put their money in and it kind of either sits there or they know they could come in and get it at any time. But really 90% went out. So when you go in, there's really 10% of your money in there. If everybody came in to get their money back, they've only got 10% back in the vault. So that's something that a lot of people don't really understand about the banking. I always use the example of It's a Wonderful Life. You probably saw the scene when they had the bank run and he had just enough money to keep people from pulling everything out and made it through. So that is basically how the reserve system of banking works. The other thing to understand is how do the banks, what do their balance sheets look like? So a bank You have assets, you have liabilities, and then you have equity in your personal life. So your assets are going to be what you have in the bank, what you might have in brokerage accounts, 401k accounts. It could be your car. It's going to be the equity you have in your house, all that kind of stuff. So you have your assets, and your liabilities are mortgages, car loans, all of that. Those are your liabilities. The difference between the assets and liabilities is your equity. So ideally, you want as low liability as possible. Banks, it's a little bit different. Essentially, your deposits, the money you're putting into the bank, is actually a liability to the bank. So it's your asset, but it's their liability. And this plays out a lot if you have a bank failure. I always tell people, you consider that to be your asset, which technically it is, but it's a liability for the bank. So if the bank ever had a problem, you're nothing more than another creditor to that bank. You get in line and hope that if a bank has a problem, you're going to get something back. You become a liability to them. Now, your deposit goes in as a liability, and then they create assets from that. Again, using the fractional reserve system. So they're going to keep 10% just in reserves. The rest of it's going to go out in mortgages. It's going to go out in business loans, all kinds of different things. They may even take some of that and buy treasury bonds or treasury bills or things along those lines. So they're going to invest that money. So it's now their asset. I just wanted to get those two things across. Typically, the size of a bank is going to be equal to the amount of deposits that they get in. So, for instance, I'm on the board of a credit union, and we've got 350 million in assets, which basically means we almost have about 350 million in deposits, close to it. So there's a very close balance between those two. And this plays out later down the road. So that's just a real quick view of what's going on with banking in general. So let's talk a little bit about the Fed. Now, there's really two good books if you wanted to get an understanding of the Federal Reserve. The first one, I probably recommended it to you if you've been a client for a while, is The Creature from Jekyll Island. So this gets into really kind of, the backdoor way that the Fed was created and how it functions. And a lot of people say that Edward Griffin, who wrote the book, is kind of conspiratorial. Yeah, you'll tell he doesn't really trust banking. And there's good reason to take that approach, but it's a really good read. The reason they call it The Creature from Jekyll Island is it was a very secretive meeting to get the Fed created in principle. There were 7 gentlemen, a couple senators, obviously a couple big bankers. They took a train down to Georgia, to Jekyll Island, where J.P. Morgan, not the bank, but the actual man, and a few other big bankers had some land. And they met at a facility that's now owned by the state of Georgia. It's basically a country club, and they hashed out how they're going to do it. And they kept it really secretive, didn't want the press to know about it. It was really kind of created in a backdoor way. The other book, America's Bank, just kind of goes through more the history of banking in general. And it's a little bit more of a drier version of the history. But very good. If you read both of those books, you can have a pretty good understanding of how banking works, but also how the Fed was created. And I always like this quote by Henry Ford. It's well that people of the nation don't understand our banking and monetary system. For if they did, I believe there'd be a revolution before tomorrow morning. So, when you get into it, you're going to see, and we know this, the bankers are built for the bankers, not for the common person. And that's sort of been the fight in our banking system dating back to when we first left the Bank of England after the Revolution. This is also a quote. This one's never really been fully vetted. If this was what Thomas Jefferson ever said, there's a lot of quotes by Jefferson fighting a central bank. But this one's the one you usually see floated out there. It's pretty interesting. Anyway. So just to give you a real quick history of banking. So again, like I mentioned, we've had really a wild ride when it comes to banking throughout our history. So when we first became a nation, you had 2 camps, one that really wanted a central bank and one that didn't. So Alexander Hamilton really wanted a central bank. he really thought it was important to do that. And of course, Thomas Jefferson, James Madison were completely against it. And this really was the basis for the first two parties that we had, political parties, the Federalist and Anti-Federalist. A lot of people say it was mostly focused on the amount of intervention by the government. Obviously the Federalists wanted more federal control, Anti-Federalists wanted more state control, and that's certainly true, but it really was the national bank that drew these parties together. So they finally kind of agreed on it, and there were, of course, horse trading. That's what you get in politics. You get a lot of horse trading. What Hamilton agreed to was to move the capital from New York City down to D.C. or around the Potomac, closer to the South, in order to get approval for the national bank. So the bank existed for about 20 years, from 1791 until about 1811. And then Congress just didn't renew the charter, just didn't see how it was helping America. There were panics. There's always been panics. So they thought, well, we could do better without the central bank. The other thing is, at the time, early 1800s, they saw that there was a lot of power in New York. Even though they moved the capital down to D.C., there was still a lot of power in New York, a lot of power in the banking, so they tried to negate that. So they didn't renew the charter for the first national bank. So for about 5 years, we had no national bank. And this really kind of created a bad situation because all the local banks would create their own currency. So if you lived in Richmond, you could have 2 or 3 different currencies from the 3 or 4 or 5 different banks that are in Richmond. They all have their own banking system. And of course, when you have that, you're going to have some banks that aren't going to manage the money system very well. So they're going to issue too much money, which creates inflation. And then they also have a problem, it really got bad in the War of 1812. So as you can imagine, with wars, you're always going to have inflation because you have such a high demand for commodities. So all the different commodities that they needed. So you have a natural imbalance between supply and demand. And then you throw in there kind of a money supply that they just started printing money in order to buy a lot of these commodities. So you had rampant inflation. So they said, all right, we got to go back. Let's get another national bank. So they did that. Still wasn't a perfect situation. In fact, again, the power consolidated into the banks, consolidated in New York City. So Andrew Jackson, who was fighting for the people, basically got rid of the Fed in 1828 and put in a system that then required that currencies would be backed by gold and silver. And that was the hope that they could stop a lot of the local banks from just printing money and keeping inflation in check. So then we had, about 25 years where it was called Wildcat Banking. What that was is it was all basically state chartered. There was nothing happened at the federal level. Everything was done at the states. Banks were still issuing their own currency, but they were backed this time by gold and silver. So you didn't have the same problem that you had when we first got rid of the first national bank, where banks would just print their money and really nothing backing it. So now we at least had gold and silver. And we went from a situation where we had about 24 charter banks to 712 banks. So you imagine when you have a lot more banks like that, you're going to have mismanagement, you're going to have bad managers, you're going to have bad bank presidents. So you saw a lot of failures there, as you still had some of these banks would issue currency and didn't have enough gold and silver to back it. So you had about a third of the banks over this period end up going under. And again, when you have a bank go under, you're going to have panics. People are going to make bank runs. They're going to go and try to get the money out before the bank goes under. Because when you put your money in there, it becomes a liability. It's no longer your asset. It's now the bank's liability. So you'd have to stand in line for creditors. So the best way to ensure you got your money back was to be the first one in line to get it out. So you still had that problem going on. So they wanted, let's figure this thing out. So what they did is they didn't go to a central bank from basically around the time of the Civil War until about 1913, but they had a national banking system. So they took the state bank system and created national banks. So now at least you have some national banks, but all the national banks were still, the currency was backed by gold and silver. You had certain banks would end up in the region would kind of become the backstop if things got bad, if there were runs on banks, there were certain banks that kind of had enough in the vault to get it through. But you still had panics. You still had that situation. Even though it was backed by gold and silver, you'd have too much currency get out there. And you also had natural ebbs and flows of dollars, which were hard to manage. Back then, being an agrarian system, we had a high demand for cash when the farmers were going to plant the crops. And then you had a high demand for cash once they were harvesting and trying to sell the crops. So a lot of times you'd see panics just from that. They didn't have enough gold and silver to back it. So the big panic that really kind of prompted the Federal Reserve was the 1907 panic. So all these bankers kind of got tired of every 15, 20 years of having a situation where a lot of banks were failing. They didn't like that, because what it meant was banks went under. And it also meant that a lot of the banks would have to step in and bail others out. Like I mentioned, even in this situation before the central bank, you'd have certain banks that kind of became a central bank in a way, in that they would have enough reserves so that if a panic happened, they would step in, buy banks at a discount. They'd make money on it, but they'd step in and kind of keep the banking system afloat. Well, 1907 was a bad panic. It was one of those, just like the normal ones, lots of banks were going bad. So the healthy banks that had ample assets didn't want to lend to any of the bad banks because they were afraid they wouldn't get their money. Just like you, when you put your money in, it becomes a liability for the bank. If a bank loans to a bank, it becomes a liability as well. So they're not sure if they're going to get that back. So the healthy banks, they always try to hold up, and it makes sense. Makes sense in a crisis. But then the banks that are bad, they're having runs, they're going to go under, it's going to cause a huge deflation. So you'd always have situations. In 1907, it was famous that J.P. Morgan, again, not the bank, but the actual man, stepped in, and he made a fortune basically taking advantage of all these panics. In the late 1800s into 1907, he'd come in with ample cash, and then he would start buying these banks. But they just talked about how when the panic hit in 1907, he brought everybody in a room, all these bankers, said, we're going to figure this out. Who's going to make it, who's not? So within 2 hours, they figured out these banks are gone. These banks, okay, we're going to fund them. And that's basically how it worked. But the bankers were getting tired of having to use their own money to bail out other banks when they had a crisis. They wanted something, a central bank, which is basically kind of in some way backed by the government or something outside of the banking system to bail them out. I mean, who wouldn't want that? I'd want that too. If I have bad problems, wouldn't it be great to have somebody who injects their own capital into me and keeps me afloat? I don't have to basically save enough on my own. So anyway, the 1913, from basically 1907, they kept working on this thing. 1910, really, the system was in place. The meetings were done. They were trying to get everything going from 1910 to 1913, really working on getting the legislation passed to have the Federal Reserve. So they basically sold the U.S., the taxpayers, on having a more stable economy, not having a monetary system that's much more stable, not as many panics. That was how they basically got that act passed back in 1913. So it was pretty interesting. Of course, I always say, look at what we've had since the Fed. We had the Great Depression, which was probably the worst panic ever. And then you could throw on top of that 2008, another huge banking crisis. So it's not a situation where we don't have panics. And we didn't have a panic at all from basically the end of the Great Depression until 2008. And I think that's mostly because of, setting it up with the Glass-Steagall Act, which took depository banks and investment banks and split them up. So depository banks are what we are used to. We deposit our money in there. It's mom and pop. We want our money to be safe. We don't mind them loaning out for mortgages or something safe, but we don't want to put it into stocks. We don't want to put them in, investments. They split those up, and we had 67 years of pretty good, solid banking system. We also put in the FDIC insurance, which I think is really the main reason we don't have runs. Back in 2008, if we didn't have the FDIC, I think most people probably would have run to their bank to try to get the money out. just because they would have feared the banks were going to go under. But most people think, okay, we got FDIC. We don't have to worry about it. We know that our money's going to be okay up to that $250,000 limit. So anyway, so the Fed got created. Now they're looking at goals of maximizing employment, stabilizing prices, and moderating long-term rates. So the Fed started off as basically just a backstop to the banks, but then they've been given more and more duties. Why are they in charge of employment, stable prices? There's a lot of things that they're in charge of. They also have to regulate the banks. So they're in there making sure the banks are doing what they need to be doing to be sound banks. The Federal Reserve was broken up into 12 districts. This was one of the ways they got it passed. So many problems we had with central banks, starting back with Hamilton's First National Bank, is all the power ended up in New York City in the financial districts. So the U.S. did not like that. So part of it was, all right, we're going to split these up into 12 banks. They're set up based on the population at the time in 1913. So you can see a lot of the banks are structured in the Northeast. Because that's where the population density was at the time. You look out at the San Francisco Fed. I mean, that's a lot of people out there for one bank, at least based on today's population. But back then, Seattle wasn't that big, LA wasn't all that big, Denver was really nothing but a small, probably mining town. So they have 12 banks. They wanted to split it off to make sure that no one area had more power than the other. Now, all of the way it's structured, these banks are, each district runs their own bank. So San Francisco, the Fed in San Francisco monitors all the banks in their area. Now, their banks in their area actually own the San Francisco Fed. So this is a private bank. These are all private banks. So all the banks up in the north of the U.S., they own the Minneapolis Fed. They own it. They get profits from it. They get a dividend, 6% dividend every year. So it is a private bank. Now it has obviously integrates in with the government in a way, but it's not a government agency. And that's something that most people think. I would say the Federal Reserve is no more federal than Federal Express. And it really isn't. It is a separate banking entity. So we've essentially outsourced our banking, our money creation to a bank. It's not a government organization. So the biggest thing, you got the 12 regions that monitor all the banks within their region, but then you have the Board of Governors, which is in D.C. And the biggest thing that they do is the Federal Open Market Committee. So that's the committee that actually sets all the interest rates. So there's 7 members of the Board of Governors in D.C., and then the 12 districts are also serve on the FOMC. Now, only 5 of those districts are actually voting at any one time, and they rotate that. So you have 12 people sitting in a room deciding what interest rates should be. Here again, is that really a free market? No, it's not really free market. You've got 12 people deciding what the most valuable commodity, which is money, is going to be set at. So they manage the currency. If you pull out your wallet, look at some of the bills you have, you'll see it says Federal Reserve note. It's actually, they control the money supply. The Treasury just prints it. So now, again, the profits of these banks, because again, it is a private bank, and the profit goes to 12 districts, but it also goes to the Treasury. So Treasury does get part of the profits that the bank gets every year. Now, the way that the Federal Reserve basically controls the money supply is through 3 different ways. One is the open market operations, which you hear all the time, the Fed's fund rate. There's a discount rate, and then there's reserve requirements. And essentially, again, what the Fed tries to do, one of the things that they're told that they have to do is kind of keep stable prices. So they clearly want inflation. They want about 2% inflation per year. That's their goal. But they want to make sure we don't have inflation like we did in the late 70s, early 80s. So they want constant prices. So the way they do that is by ebbing and flowing the amount of money coming in and out of the markets. And these are the 3 ways that they do it. So again, the first one, the reserve requirements. We already went through this chart showing that right now you put $100 in, they're going to put 10% reserves. So if we start to see inflation, if we start to see prices going up a lot more, or even if we see banks starting to have issues, what you typically want to do is raise the reserve requirement. So you go from 10% maybe to 15%, maybe up to 20. What that does is it keeps money from getting into the system, getting into the economy. So your $100, if we have a 20% reserve, they're going to put 20 in the vault and it only can lend out 80 instead of a $90 if we have a 10% reserve. So it keeps that escalation of money from growing. So that's the way they could let it go. On the flip side, they let the reserve requirement go below 10, like they are right now, if they're trying to generate economic activity. So if they feel like we have deflation, where prices are dropping, they're going to try to get more money into the economy and use that fractional reserve banking to build it up and get us to where we're not deflating, or at least keeping same prices or maybe inflating a little bit. So the reserve requirement's the first way. The federal fund rate is probably the most famous way. You always hear about that. What's the Fed rates? Pretty much everything is kind of tied to this in some fashion. You know, the biggest way that you feel it is the amount of interest you get in your bank account is really tied to the federal funds rate. So as this thing goes down, the amount of money you're going to get on your checking account or savings account goes down. This is the biggest way that they control it. And again, the way they do it is if they want to pull money out of the system, they want to slow down lending, they want to slow down inflation, they raise the rate. So you can see here in 1970s and early 80s, the Fed's fund rate went up over 17%. You may have tried to get a mortgage then, and you were paying high double digit for your mortgage. That's why, because the Fed just raised their rates considerably. It was also a great time to have money just sitting in the bank because you'd earn so much on it. But what they were trying to do was get money out to stop the inflation, and it worked. It did work. Created a really strong recession, but it did work. It killed inflation. Right now, what are they doing? Well, rates are near zero. So trying to get more money in there, get more economic activity, actually create some inflation. That's what they're trying to do with the federal funds rate. The federal funds rate is really nothing more than what banks lend to each other overnight. So if I own a bank, I might need to borrow some money, and then I go out and I can do it right now. It's 0.25%. So I can borrow at 2.5% from other banks. Now, if other banks aren't coming in and helping out, the Fed will do that. The third way that they do it is the discount rate. So I just mentioned the Fed will step in and act as a lender of last resort if none of the banks. So if I'm a bank and I try to get some cash, I need some money, I need to borrow, nobody wants to loan to me because it's uncertain times. Well, the Fed steps in and loans it to me, and then I borrow from the Fed. So the discount rate is the amount that the Fed is going to charge me to borrow the money. Right now, 0.25%, not very much. Here again, how do they control the discount rate? So the Fed, obviously, if they start raising if I borrow money from the Fed, I'm at 0.25%, and we start to see inflation, they're going to raise those rates. They're going to raise those rates to the point where I give that money back. I'm going to pull money out of the economy and give it right back to the Fed. That's how they can control inflation. So they're always pulling these three levers: reserve requirements, discount rate, Fed's fund rate, to try to make sure that we have a kind of a stable monetary system. Now, historically, what has happened, if I'm a bank and I want to go to the Fed and borrow money, I've got to give them part of my assets, right? I get the deposits from you, and then I have assets. The assets are going to be the loans I put out there, mortgage loans, all that kind of stuff. But I also invest in treasuries. And really, for decades, what happened is if I wanted to borrow from the Fed, I would have to give them some treasury bonds, and then they would give me an infusion of cash. So if you look, this chart gives you an idea of the Federal Reserve's balance sheet. Now, it goes back to 2007, but if I took this chart back to the 1960s, what you would see is pretty much a consistent line. So the far left of this chart, you can see it was about $800 billion. That's where their balance sheet had been for decades. And you also notice very dark blue on the far left. That's treasuries. Okay, so their balance sheet, the Fed was basically filled up with treasuries, guaranteed no losses, because the Federal Reserve is actually prohibited from having assets that could cause a loss. So we have decades with the Fed just having treasuries, pretty boring. A bank would come in, they would give a treasury to the Fed would loan them some money, and they do what they needed to do with the money. Well, 2008 happened, and we got leveraged up so much. Now we had issues with bad assets. So you can start to see after 2008, look at the different colors, just the different colors on the Fed's asset sheet. So they took in a ton of mortgages. They took in all kinds of other borrowings of other assets that the banks had on hand. So all the banks came to the Fed to get some money, but they didn't really have all treasuries. They had to give, it was really a situation where the Fed just opened up their balance sheet. So if I was a bank and I had a loan, a mortgage, let's say I gave it out for $300,000, now it's only worth $200,000. I was giving that mortgage, even if it was in default, to the Fed. We were actually pricing it still at $300,000 instead of its actual price of $200,000. And then they'd give me an infusion of $300,000 of cash. So I was able to get a much stronger balance sheet, but all of this went to the Fed. So the Fed's balance sheet went from $800 billion to $4 trillion over a short period of time. So again, what happened there was, if I was a bank, I was taking assets off of my sheet and giving it to the Fed. A lot of them were bad assets. They were bad mortgages, mostly. Give that to the Fed, and then I get a fusion of cash, and it kept me stable. So this is important to remember that. It didn't affect the deposit side. So if I was a bank that was $350 million in size, I stayed at $350 million. The only way I can get bigger is if I get more deposits. If I get another 100 million deposits, now I'm 450 million. It grows that way. So with the Fed, all I'm doing is basically taking my bad assets to them and getting fresh cash. The Fed would print that money, and I'd have fresh cash. Now, a lot of people say, why didn't we have massive inflation when we did that? Why didn't we, if the Fed was printing this money, if they took this asset off of my balance sheet and just gave me cash, how did that not result in more money? Well, again, the only way you start to have inflation would be if the liability side, if the deposits went up. If the deposits go up, the fractional reserve banking is going to create more and more money in the banking system. That's where you start to get inflation. If you have a creation of that, if more deposits come in and we use the fractional reserve banking, and all of a sudden we get more and more money going out, but the amount of goods and services available stay the same, that's how you get actual price inflation that we feel. Okay, it's kind of confusing, but really it has to come through deposits. As a bank, that's the only way I get bigger. So if I took a bad asset, gave it to the Fed, and I got an infusion of cash, well, a lot of the banks just kind of sat on that just to make sure their balance sheet was good. But there were a lot of banks, though, that they did lend this out, but they didn't lend it out to where it created more deposits. They kept it on the asset side of the balance sheet. So they would get this money in, fresh, clean cash from the Fed, and then they would invest in stocks. They would invest in bonds. They'd invest in real estate. So what you have seen is asset prices have gone up considerably. So that $3 trillion that the Fed has created went into asset prices, but it didn't go into price inflation. It didn't increase the deposits or the liabilities of the bank, but it just took the assets. And when that money started chasing stocks and bonds and real estate, that's why you saw price inflation. Okay, so we had asset inflation because of that. We didn't get as much price inflation. And I'm not saying we didn't have any price inflation. Obviously we do, but it isn't the equivalent. If they'd have gone back in the 1980s and put $3 trillion into the economy like that, yeah, we would have seen some massive price inflation. So this is just a quick chart to show you what the stock market did as the Fed really started interjecting a lot of what is called quantitative easing. So here again, what was happening is the banks were coming with some of their bad assets, giving it to the Fed and getting clean cash. And then they were taking that money still on the asset side of their balance sheet and giving it to hedge funds or private equity or investing it themselves through their investment banking arm. And it would just go into stocks, bonds, real estate. So you can see as the Fed was really opening up the door, as they were taking in a lot of the assets, the stock market did very well. And they had these periods where they did what they called quantitative easing. So they created a situation where they were buying more assets from the bank. Every time they let the quantitative easing slow down, the market pulled back. So you continually saw this process where things were going up when they were getting more money in the asset side of the balance sheet, the banks were. And then when the Fed stopped their quantitative easing and some of that money would come out, well, we'd have asset price deflation. Okay, so that went on and on and on. And a lot of this, like I said, it got to stocks and bonds and real estate. It didn't really kind of stay into the consumer side. We didn't see the price inflation because of it. So the Fed would never do that in the past. They'd only take in treasuries. So you never really had that situation all that much. They kept the balance sheet at $800 billion. Banking system was fine for decades. And then when we had the 2008 implosion, now they got creative. They started taking different asset classes. They started taking on bad mortgages. They were taking on other debt instruments that were going derivatives. So the Fed was taking a little bit more risk. So now we get to today. All right. So 10 years ago, we had that. Now we've got another situation. And what scares me about it is the Fed is now getting into a lot of different asset classes that they really have no business getting into. The worst one is with the recent CARES Act, the Treasury took $425 billion and created what they call a special purpose vehicle. So now the Federal Reserve is technically going out and buying exchange traded funds on corporate debt. So they're going out and buying corporation bonds, bonds that have been issued by companies. So now we've gone from where they would take money from banks directly. They were taking usually treasuries, but sometimes they would take mortgage-backed bonds. Sometimes they would take other collateral debt obligations or other derivatives. They were just basically taking off the bank's asset side. Not great. They should have stuck to treasuries. They started expanding, getting into asset classes they probably shouldn't. Well, now they're going even bigger. So now they're getting into buying ETFs on the open market. Now they're still technically corporate bonds, but they're also buying with junk bonds. That's the biggest thing that this money's going to. It's going to be investing into junk bonds. What are junk bonds? Well, they're bonds issued by corporations, but they're corporations that have very bad balance sheets. They're corporations that, like it sounds, are junky. Their credit's not very good. So they're going and they're buying these ETFs, basically buying back junk bonds. And right now, it's companies like Ford and GM that have been struggling. GE is getting to that point. All these bonds that are getting downgraded are junk bonds. A lot of them are going to be the oil and gas exploration that we saw back in, that they're having all the problems there in the Midwest and down in Texas. So they're now just getting into the market directly and buying these vehicles. So, I mean, we're really only one more step away from them coming in and buying stocks. So, hopefully I've shown you as this has progressed, we're getting to the point where we're having less and less a free market, honestly. And, while this kind of has helped the market, the stock market and the bond market very recently, because they have a new buyer who doesn't care what they pay for the price of the ETF or the holding. So it's kind of helped stabilize things, but you're getting less and less of a free market. So if you believe in free markets, you're not happy about this. And you're also getting the point where you're destroying any kind of price discovery. How do you invest if you know that you get the Fed back and you say, well, let's just get really aggressive. But the problem is, if you look at some of the other central banks that are ahead of the curve on us, they're already investing in stocks. Like in Japan, they own 25% of all stock ETFs in Japan. But it really hasn't helped the market. Their market's not doing well. It's been doing a lot worse than our market. So you can get a situation where you're going to force people to end up taking tons of risk because you can't get any interest on your bank accounts. So you're going to put it into more aggressive like stock funds because you figure you got the backing of the Fed. But then you have something like this happen and the market drops 30, 40%. So we're getting into kind of a bad situation. But what is really bad about this, the special purpose vehicle that the Treasury kept. So I showed you the slide on how the banking system works. It leverages, right? Fractional reserve banking. So the Fed is going to take this $425 billion and put it through the fractional reserve. So they're essentially going to be able to buy close to $4 trillion of bonds based on that $425 billion. But you might have also remembered me saying that the Fed is prohibited from having any kind of losses whatsoever. They cannot have losses. So how do they do that? How do they buy junk bonds and not have any losses? Because the thing is, some of these bonds are going to go bad. If a company goes under, it's going to default on the bonds. If you have an oil well out in North Dakota and the price of oil goes to 10 a barrel and they go under, they can't keep functioning, the bonds are going to go defunct. So how do you do that? How's the Fed get around that? So the Fed's got now $4 trillion of all these bad bonds, and if 10% of them go, we've gone through that $425 billion. And that's the thing. Essentially, the Treasury raised $425 billion, and they're doing that with treasuries, right? So they're issuing the debt because we don't have enough tax dollars to cover it. So this whole $2 trillion of CARES is going to be strictly treasuries. The $425 billion that was taken out of that, given to this special purpose vehicle, is essentially going to get wiped out. So as these bonds go away, this is money that we're responsible for as taxpayers. So that's going to be gone. We're basically subsidizing the losses of what the Fed does here. So what happens if it goes more than $425 billion? Well, the Treasury is just going to go back to Congress and get more money into the special purpose vehicle. So we're on the hook for whatever, it could be however many of those bonds go bad. If 25% of it goes bad, we got $1 trillion that we as taxpayers are going to add to the national debt. So you can see we're really going down a slippery slope here. And what happens if they start doing this for stocks? What if we start doing this, so if the stock market starts to go south, we're on the hook as taxpayers. We're subsidizing essentially all the investors out there. So it's really a bad thing that's happening long term, because the problem is, how's the Fed going to get out of this? Everything they did in 2008, whenever they tried to get out of it, the markets tanked. See, again, this was the quantitative easing. Anytime they tried to pull the reins back at all, the market started to drop, the Fed started to panic and went back and injected more money. So now we're getting to the point where they're going to be in junk bonds and eventually, I think, stocks. If the stock market pulls back, they'll figure out a way to do it. So now we've got a point where we're on the hook for the banking system again as taxpayers. So the problem is, as the Treasury continues to increase the national debt. So this year we're going to have probably $4 trillion deficit easily. We know we had $1 trillion deficits before this. The CARES Act was 2, so we know we're at $3 trillion. We're probably going to be at 4 when it's all said and done, because tax revenues aren't going to be as big as they were last year because of the loss of economic activity. And they're probably going to go back and do more, take more to try to keep the economy going. So all of a sudden, if the Fed ever starts to the point where they're printing the money, rather than doing it with the banks, right now they essentially take it off the asset side of the banks. So that's why we haven't had price inflation. But if we get to the point where the Fed actually starts to just print money and buy treasuries directly, now we get to the point where that gets on the deposit side. Like I said, the time you see price inflation is when deposits go up, because the deposits come in and the banks use a fractional reserve banking to create, every $100 you put in creates $1,000 of banking. So if they're giving money, if they print money and give it straight to the Treasury to pay the bills, that money does become liabilities, because the federal government's they've got contracts, federal contracts for defense. They've got contracts for, all the agencies. And then, if I'm a defense contractor, I get that money. I'm going to pay my people. What are they going to do? They're going to put that money into the bank. It creates those deposits. So we're getting pretty close to the point where the Fed is going to start doing that. In the past, so far, we have been able to find buyers for our debt. As bad as our debt was, we've had a lot of banks would buy our debt. We've had foreign countries buying our debt. And then we have individual investors buying treasuries. So we've been able to actually cover our treasury debt with outside investors. But if we get to the point where it's too much, and then the Federal Reserve is essentially going to just print that money and give it to the treasury, that's when it's sort of game over. That's when we're going to start to see inflation. That's when it can get a little bit ugly. I know I'm rambling here, but I just wanted to give you kind of an overview of how the banking system works. And you can kind of see what's really going on with that. We're on a slippery slope, and I don't know what is going to pull it back, quite honestly. I'm kind of afraid that, if this gets to the point where we're just outright monetizing treasury debt, that's where we're going to go back to the 70s. We're going to see that double-digit inflation without any problems whatsoever. So anyway, yeah, any questions on this or questions in general? Okay, why didn't deposits at banks increase when asset prices increased? Again, it's a flow of the balance sheet for banks. So you have to have deposits come in that increases the size of the banks. It increases the money that goes into the economy because of the fractional reserve. So when the Fed would buy, all they were doing was swapping assets with banks. So a bank would give them either a treasury, they would give them a mortgage, they'd give them something like that. So it was an asset for asset swap. And then when what the asset was, so the asset from the bank, the mortgage, the treasury would come in to the Fed, and the Fed would just put cash here. So a lot of banks that were really in bad shape just kept the cash. They wanted to stay solvent. So you didn't have anything that was actually going to be turned into loans. It wasn't anything that increased the deposits. It just sat there. But now some of them took that money and put it into stocks, put it into bonds, put it into real estate. So you did see a lot of assets are already created, went over to the Fed, and their balance sheet went up, and that money came over here, and then it went into all the different other asset classes. So it's kind of a nuance, but it stayed on the asset side of the bank's ledger. That's why we had asset price inflation, but not price inflation. Now, like I said, if the Treasury starts getting just printed money from the Fed, we're going to see the deposits go up. And at that point, you're going to start to see more inflation. You're going to have a higher money supply because of fractional reserve banking, but you're going to have the same amount of goods and services. So more money chasing the same amount of products. Think of playing the game Monopoly. You get your certain amount of money at the beginning, and then you buy properties with it. Well, if all of a sudden the bank handed you more money and we kept the properties the same, you're going to have more money chasing the same amount of properties. So the price is going to go up. Any other questions on anything going on? Markets have done well because of, I think, what the Fed did. That chart that showed you the high yield ETF, it tanked in February and March, and it's pulled back drastically. It's not back up to where it was. So high yield bonds, junk bonds have pulled way up. So the stock market's also gone up because of that, because people think, well, probably stock market's next to get something where the Fed steps in. When the banks sold the stocks here's the question. So the banks sell the stocks that only increase the asset balance. Banks still didn't. Okay, so yeah. So the banks can profit. The question is, so if the banks took this money from the Fed, put it in stocks, and they profited from it, they sell the stock, now they have a profit. Wouldn't that kind of get in there and create price inflation? No, it didn't. Just two things. One, they pay back the Fed, so they get their asset back. So a good portion of that money, just again, asset transfer. The other thing is the bank balance sheet. You have liabilities and you have shareholder value. Okay, so the balance sheet, let me see if I can pull this up again real quick. Sorry, I'll try to explain this. So the value of the bank did go up. So here's the balance sheet: assets, and then liabilities plus equity. So if they sold some of the stocks or some of the bonds or some of the real estate, and they had a profit, again, they would pay back they'd flip it back to the Fed. They could. They get their asset back. So a lot of it's just an asset side transaction. But if they had a profit, it goes down to their equity. So the liability stayed the same, but the shareholder equity. So the value of the bank would go up. The bank becomes more valuable as an overall institution. That's how the stock price of Bank of America, that's how the stock price of JP Morgan, that's why they go up, because they see their equity go up. So if you ignored the equity, all these banks would only be the amount of deposits they have and then the loans they make on those deposits. Well, the value of the company overall goes up as they make money off that. So if they take a deposit and they pay you 0.5% and they loan it out at 3%, they've got a 2.5% spread. Obviously, they have expenses, they have personnel, they have buildings, things like that. So that'll take part of that spread, but what's left over becomes equity, shareholder equity. Now that could go out in the form of dividends, that could go out, a lot of different ways, but the value of the bank goes up. So it does sit there. It does make the bank a little bit healthier. Obviously, they'll have some equity if things got bad. But the problem is when you start doing that, a lot of these banks that were holding stocks, when the market goes down, now you've got the reverse happening. So it gets pretty ugly. So any other questions on anything that's going on just in the economy, any other questions that you might have? I know this was kind of a confusing session, and banking is really something you need to spend a lot of time learning about. It's amazing when you really get into it, when you start to understand it. But I highly recommend the 2 books I put out there to begin with. They're really, really good stuff. You'll really understand a lot if you read these 2 books. And there's a lot of videos on YouTube as well. You could just do Federal Reserve. Did you notice Bank of America went up this week? Yeah, absolutely. Yeah, banking stocks did. Yeah, they did pretty well because of this, because they know that this is coming. And another question: are bank stocks too risky now? Well, some of them, yes. Some of them, probably not. I mean, there's still some really good banks out there, but there are some banks that I wouldn't go near that sector right now. And it all depends on how successful the Fed is at this whole process. My big thing is as they come into it with all this money, how are they going to exit it? Are we going to be able to do that without having some issues? I just don't see how we do that. I hear people talking about pausing the payroll tax. What's the payroll tax? A payroll tax is just your Social Security and Medicare tax. Okay. If the Fed income, state income, Social Security, Medicare taxes, or just some of these. Oh, yep. Yeah. So ask about the payroll tax. That is your FICA. That's Social Security, Medicare. So usually if you're a W-2 employee, your employer pays half of that and you pay half. And the typical FICA tax is 15.2%. So again, you pay half of that. Your employer pays half of that. If you're self-employed, you pay both sides of that. The reason they try to do a payroll tax cut instead of just an income tax cut is because a lot of lower income folks, people making less than $50,000, they don't pay much in the way of income tax. So reducing income taxes isn't going to help them, but reducing the payroll tax, which is that would give them a guaranteed 7.5%. That would inject more money. So it's really a way to kind of help lower income folks get some more money. Did you notice Boeing went up this week? Yeah. So I mean, Boeing and the airlines got just a massive bailout, and I didn't agree with that. I think that if you have certain principles, you should have the principles in good times and bad. So if you believe in free markets, you believe in not when just asset prices are going up, but when asset prices are going down. And we have in place very good systems in Chapter 11 and Chapter 13 bankruptcy. And what that does is, rather than us, again, as taxpayers stepping in, we're bailing them out. The Treasury is issuing bonds to raise capital to give to Boeing and give it to all the airlines. Now you say, well, it's not their, this is something you couldn't see. It's a virus. Yeah, but that's why we have Chapter 11, Chapter 13. So you go to Chapter 11 bankruptcy. The bondholders and shareholders are going to take a haircut. They might lose their entire investment, but the company keeps operating. So bankruptcy court sets it up so the banks still fly, the employees still get paid, everything operates as it should. It's just the people who invested in the company are the ones who are going to take the loss, and that's how it should be. So if you invest in a Boeing and there's no airplane sales, then you should your stock should go down. You should take a hit. So yeah, I did notice that. How do Treasury bonds operate in financial times like now? Are they good investments, and do they make money out of the system? Well, so Treasury bonds operate a lot of it on supply and demand. So the very short end of what they call the curve. So the Federal Reserve can kind of control the Fed's fund rate. That's overnight rates that banks loan to one another. It's very short term. But when you go out to the 5-year Treasury, 10-year, 20-year, 30-year, that's all right now controlled by the market. And this is individual investors, it's pension funds, it's foreign governments, it's all the different investors, and they're deciding what they're willing to pay, what interest rate they want. So interest rates have come way down. I mean, the 10 years like 0.7% now. 30 years, just over 1%. So you're saying you'd give the government money for 30 years and only take 1% per year. That's pretty low. And that's because treasuries are seeing they're a guaranteed investment. So at least you're going to get your money back plus that interest, because the government can print the money if they have to, but it's guaranteed. Whereas other investments, you're not guaranteed anything if you invest in stocks or high yield bonds, junk bonds, anything like that. So there's been such a demand for treasuries right now that rates have come way down. So what you're seeing on the 10-year and the 20-year and 30-year is just people running to the risk-free assets in running away from the stock market. So that's what you've kind of seen with those. Okay, any other questions from anybody? I don't see any. But I appreciate you taking some time out. We'll do this again next week. I'll probably jump back into more of the investment side of things. We'll look at some stuff. I might talk about some sectors I'm investing in right now for clients. We'll make it a little bit more, I guess, fun. This was a little bit meaty. This was a little bit nerdy, but it's important stuff, because as you start to see these things come into the news, you'll start to understand a little bit better the ramifications. So I've heard very little outside the financial media about the SPD, that vehicle where the Treasury's given them $425 billion, and they're going to leverage it up to $4 trillion. And then we're on the hook for losses. You don't see that in the mainstream media because it's a pretty confusing concept. But hopefully now when you hear that stuff, you're going to kind of understand what's going on. So again, have a great weekend, and we'll talk to you soon. Take care.